Are equity markets overvalued after the recent rally? Maybe, but there are huge exceptions. Let's have a look. US equity markets admittedly had a huge run over the recent months and look now expensive again. But there are regions where this is not the case at all. In our last video, we had a look at the European equity market, where the discount versus US equity markets has hardly been bigger at all. Another region where this valuation discount is even larger is the region in East Asia, China, emerging markets, where we'll focus today. Here in the slide you see the development of a broad Chinese equity index. And yeah, it has also performed nicely over the last 12 months. Last year, Chinese equity market was even one of the strongest of the large equity markets. But you also see it's still far below the highs reached in 2021. So no word about new all-time highs in the Chinese equity market yet. Which brings us to valuations. The line here shows the average valuation of emerging market equities. So not only China in this case, but a broader sample of emerging market equity markets. But be aware, in emerging markets, China plus Hong Kong, Taiwan make roughly 50% of the total because that's where the large companies are located. So when you talk emerging market equities being cheap, we basically talk about China and East Asian equity markets being cheap. And what you see here is this line, the valuation discount versus the US equity market has hardly ever been as low. So the discount is huge. On average, emerging market equities were roughly 20% cheaper than the US equity market. Currently, this discount of emerging market equities is almost double at roughly almost 40% discount. And this offers room for outperformance, even if the discount closes a little bit. Emerging markets, and again, where it comes from, the cheapness is East Asia and China, would have room for outperformance. Emerging markets outperforming the US sounds like science fiction, does it? We all know how it was over the last 10 years. US equity markets performing much better than every other equity market, and especially the large 10 tech companies in the US. And you see it here in the chart, which shows this line going up and down, the relative performance emerging market equities versus US equity markets. So when the line goes down, emerging markets were performing less than the US equity market. When the line goes up, emerging markets were performing better than the US equity market. And you see the recent history, the last 10 years plus, this line goes down, 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 down. Means year for year, US equity markets were performing better than emerging markets and then almost everything else. But if you go back further, you'll see that after 2000, there was a long period where emerging markets were outperforming the US market tremendously. Just most of us don't remember this anymore. And if you go back further, US equity markets have been outperforming, and before that, emerging markets were outperforming. So this is oscillating. So where does this leave us? Of course, in a broad equity portfolio, US equity market has its place. But I will take a look how much in your equity portfolio you have already room for emerging markets in general, in here especially the really cheap, strong growing region with strong tech companies, which is actually East Asia, China, and the countries around there, and make a little bit more room maybe in your portfolio for this part of the equity market. But what about Trump and the trade war? Well, the trade war is going on now for months, and you hardly see it in the chart. And be aware, China is a huge economy. The US is also dependent on the Chinese market. So in our view, probability is very high that there will be an agreement which is not too negative for China in this respect. Don't forget about this region, China, East Asia, in your equity portfolio. Don't forget to like and subscribe us. Wish you a nice summer and see you next time.